Good morning or good afternoon, depending on which side of the country you're joining us from. Thank you for joining us for an economic update here as we roll into the end of the year. Happy November. I'm Charlie McQueen, President of McQueen Financial Advisors. Want to thank everyone for joining us today. We have our three business lines, or three main lines, which start off with actually we'll go a little backwards today, but we have our valuation activities and transaction advisory. We have our asset liability management and CECL team, and also our investment advisory team. And really excited to have here with me Craig Cecilia, the head of our investment advisory team and co-presenter today. Craig, thank you for joining me.
Hey, you're very welcome. Glad to be a part of today's presentation.
Yeah, we're going to have a lot of fun here. Craig does oversee all of our standard investment portfolios, our alternative investment portfolios, and also our foundation and not-for-profit area, managing portfolios there. Big growth area for us. We're really excited for Craig, you and your team to be doing such a great job there. Thank you very much.
Yeah, you're welcome.
All right. Every time we talk about the economy, it starts off with a really simple question. When's this inflation going to end? Is it going to destroy the economy? Is my home value going to go up? What's going to happen to the stock market? Wow, our loan price is high. That's the short version. But today I want to kick off with what's the inflation that we're having? Why do we have the inflation? And for how long is it going to be around? And then what's going to happen from there, Craig?
Well, eventually we're going to get to a point where we're going to basically put the wheels down, is what I like to do in the analogy. And that's what we all hope for when we're in a plane, is a nice soft landing coming through, right? It's some people think it's a little bit more of a gentle glide right now.
I really don't like the alternative to that right now because I'm going to be on a plane soon. So
Right.
that just didn't sound good. But
Yeah, let's be optimistic on
I
everything.
love it. Yeah, but the Fed's going to win. They're going to keep rates high or raise rates more if they need to make sure that inflation stops going up, which it is. It's still going up, but at a slower pace is one of the things you're going to tell me in a couple slides, I bet. All right. Well, inflation measurement here, and this is actually one of our favorite set of charts that you'll see normally. The Federal Reserve Economic Data, FRED, short version. They have these great charts, and one thing you'll see is whatever we're looking at here is inflation, for example, is the blue line, but in the background you have the gray bars, and those gray bars represent recessions. And one of the things we'll see, a lot of things here, a lot of these charts will show you we're at levels that would basically be that we've been in a recession when we've hit these levels before. So if you look back into the 1990s and 2008, in 2002, three, whenever we've had these big moves, we end up having a recession. And here we've had some pretty big inflation moves, but we're not suggesting a recession so far. I'm a little surprised.
I think there's a lot of people out there, many schools that say there's a recession or we're actually in a recession, right? And I think it's just a matter of which data points you're really looking at. And I think that's why they don't really say we're in a recession. They look back at historical data and come out with and make the statement that, hey, we were in a recession. So we'll have more to follow on that from the academics on that next year is what I'm guessing.
Well, here we'll see that the rate of inflation is coming down. CPI is at 3.7, X is now at 4.1, and PCE at 3.7. And looking here at a more of a short-term picture, it is coming down, Craig. You tell me it's still rising, but at a slower pace.
Yes, rising at a decelerating rate is what we sometimes like to say. And this is actually a super cool chart. And we look at the green chart, the longer one. And so we did a trend, and it was probably for a little over 18 months. And you can see the trend of both the core CPI and the core PCE are trending down at a nice, easy pace. And what we really want to focus in on as well is the shorter term. If we tighten up that trend for only a year, now you can see it decelerating at a quicker pace. And it's once again, the trend is your friend, right? Goes along with a lot of things.
Yeah, you're only wrong once.
Absolutely. And the ties I have in my closet will come back in style sometime and it'll be a new trend, but I'm relying on that. And so you can see it's just amazing how some of the prices are coming down. And that's what one of the goals and one of the legs of the two-leg mandate of the Fed is, price stability, which we're getting to, and then inflation, which we'll talk about in a little while as well.
Price stability, full employment, and those are the keys to success here. And that's what the Fed wants. So we're going in the right direction, which I agree. We are still seeing some struggles a little bit. Oil prices are still high. A lot of things geopolitically. We'll talk about wars later and some things, but yeah, I'd love to see oil prices come down a little bit to make some things more affordable. But this is something where we have a pretty bad energy policy that may be coming out with a lot of EV conversations right now, but we'll see what happens there. And the next slide is gas prices. It's interesting. They were definitely up high, and they've come back down a bit here. We're tending to see some shipping data show lower economic activity, but gas prices are still seem pretty high in my book.
Yeah, and they're volatile along with those oil prices. We were showing charts of about 80 some dollars of oil. They've come down to 76. The the 9-year average for oil, by the way, is around 60. So we're not too far off that, quite frankly. And if you kind of look at long-term inflation, you apply it to it, it's not that bad of a number where we're at right now.
60 to 90 is only a 33 to 50% difference, depending on which kind of math you do, right?
Tomato, tomato.
Yeah,
Um,
no, you expect it to go up, especially as we're trying to go to other energy sources. It's a fair point, and some of those low points go back to the days there in 2020 when we had negative values, which were just out of the ordinary there, and so it is recessionary times. There's less demand, so it does make sense that it's up, but. I think as we look at gas prices, I was hoping we get a little bit of a relief because consumers appear to be getting a little stretched right now.
Oh yeah, we'll see because of all the inflationary things, and we'll talk about other energy in Michigan here where we're at, it's been as high as 350 down over the last month down to 295, depending on where you went and what kind of affinity program you have with your at the gas pump.
Right, right. I love affinity programs for airlines and gas pumps, although the airlines, I think, got rid of them. But energy prices here, as you just mentioned a second ago, definitely much higher. We've seen a poorly run transition from fossil fuels to renewables. And we start looking at the rest of the world, we're definitely more reliance on nuclear and other activities. I hope someday we'll start to get a little smarter in this transition. But one thing we did see is even the state of Michigan, where we just closed our last nuclear power plant, they're now attempting to reopen it. Even our governor, who voted to close it, is now voting to reopen it. So we do need more energy. We need to transition to clean energy, absolutely, but in a timely basis. So this is something that does make us less competitive, and that's something that does make me nervous. All right. Well, energy prices are high, so we could blame them for inflation, right?
Oh, I think that's a good way to look at it. And one of the things I think in the long term for energy and benefit to renewables will, as we do become more developed into technology for new renewables, I think that is providing a lot of headwinds for renewable energies. Um, Not to play a little pun on, wind energy or anything of that nature, but we do need to get better at it because a lot of the programs are from the government are out there supporting some of the renewable programs out there that can't be self-sustaining at the moment.
Yeah. And so it is some of it is a cause, some of it is a result. And so I think it's an interesting battle.
Yeah.
As we look at inflation, though, I think we're all pretty much in the same boat here that the inflation we have today is a result of the helicopter money that came in during a pandemic. And we talked about it during the pandemic, just the sheer volume in a number of webinars we did, which talked about the sheer volume of cash being dropped in all the programs. It was individuals got some, businesses with PPP, the Employee Retention Act, ERC credits, also the municipalities that lots and lots of money, and state governments got lots of money. And so we're seeing a lot of different areas get money. It's all being spent, not at once, though. It's one of the things like around here in Michigan, every road's under construction because it's more fun that way. But it's because all the money that went to road construction, it's going to take a while for it to burn through. But we are beginning to see money come out of the system. We're seeing M2, which this graph is money supply. And you can see here all the recessions in history. It's kind of an interesting graph here. We don't see it come down very often, do we?
No, it's kind of a generally rising unless there's a unique situation. And not to be a proponent of having so much liquidity in the system, but if you do just a straight line trend from the 2007 era to today, we're actually right where we should be if we wanted to maintain that money supply growth. I still think that that growth is a little bit high of where we should be.
Yeah, it's come a bit too high, I think. And but what that money supply growth did is really give us a lot of savings growth. And so here's a copy of an incredible chart to me. I mean, we're going back to 1960, and as we go forward, you can again see whenever we usually get these spikes up in savings, that means we're in some sort of a recession. Now we do have at the beginning of the spike here, the recession that was called because of COVID and the pandemic, but we definitely stayed up much higher for longer with the savings rate. But we're back down now to some pretty tough levels. This is where we're seeing deposit runoff type levels.
Yeah. And as we look at and talk to all of our clients, we're seeing quite a bit of a draw in 2023, right? That happened on our balance sheets. No two ways about it. Our expectations now is not to have that spike because we don't expect to be a terrible recession, but we do expect that there's going to be some more runoff. People are still spending and they're charging, they're running up their credit cards, and that's not a sign of saving. It's actually a reverse of the number there.
Definitely an interesting thing here. And I think that we're going to see the savings rate continue to be a challenge. Again, the cost of things. CNBC, a great line was if you go to the grocery store today, everything's at a minimum of $8. And it was just kind of fun. So I do think there's going to be consistent pain here in the savings rate. And so from going from there to change over a little bit and talk about the next slide here, um, you know, we're going to see some interesting issues coming up here. And I do think we're going to see from the savings rate some pressure and the economic issues out there, some pressure that's going to lead to some lending issues. And we want to talk a little bit about mortgage and auto and commercial real estate here. But looking at the overall picture, it's interesting. We have continued to see loan growth. We obviously got flat a little bit in 2020 and 21 with a lot of PPP funds and things that have come in over the years. But we're not seeing a huge growth right now. We appear to be flattened out a little bit just with a couple quarters worth of data here.
Right. There's a lot of reasons that's gone into this, not only credit reasons for lenders, but also from borrower standpoint right now at the moment. And we see that this is going to trend forward a little bit as well. We're not going to see a big spike or huge drop in these outstanding total loans and leases on a go forward basis.
Yeah, it's tough to add when rates are high, but it's also really tough to add when credit standards are tightening.
Ooh, what
Um,
a chart. Look at
yeah,
this.
and this is one of my favorite ones because it just goes back and says, gosh, every time that's the red line is where we are today across the top, going back over time, back to 1990. And what we can see here is that every time we've been at this level of credit tightening, we've been in a recession. And so, and again, this is not, I'm not trying to be a negative person to talk about this, but recession, it's really interesting what charts say. And then we go back to that deposit growth, the cash growth, the M2 growth, which is really offsetting a lot of these standard methodologies of predicting the economic activity. But Craig, basically, this says that everyone's tightening their loan standards.
Yeah, it kind of does. And if you're on this call and listening, and you might want to share it with your peers, is kind of to talk about this. Because if you're not really adjusting your credit standards, or you're only using one metric, like raising interest rates to account for more risk, which is a way of tightening, right? Of adding on spread for risk, you really should be looking at several things. And one is, and this applies to all size borrowers, not just small or medium or large size borrowers, but it's a spread to your riskless. It's a premium for riskless loans. Another thing that's also grown is higher fees for credit lines, putting them in there as well. There's all aspects that are tightening up, and history doesn't necessarily dictate whether it's correct now, but it is kind of a smart thing to be doing right now that everybody sees the like around the corner is potential recession or slow down the economy.
Yep, it definitely shows the potential there, and it's tougher to get loans. When it's tougher to get loans, people do less projects, and then along with tougher to do things, it's an interesting modification when we start to see what happens when you add rates onto this equation. Um, this is a picture of prime rate, and which is we all know 300 basis points over Fed funds. It is high. It's way up there. And so people that are going to get loans, floating rate loans, resetting, it's become extremely expensive now at 8.5%. And I think you've got to go back to, 2021. We got to go back, or 2001, excuse me, not 2021, 2001 until we were at these levels, or 2000. So it's going to be a big shock to a lot of people as they look to borrow stuff today.
Yeah, I agree with you on that entirely. And the question is at the end, we're going to close up prediction of interest rates and Fed funds, right? So we're not going to talk a lot about this. It's just the big question is where do we hang at this level? Is it going to be for a short time like we saw 2006 to 2008, or quite frankly, right at the pandemic, or going back to the late 90s, early 2000s? That's what we really want to identify to help budget for next year.
Yeah. And I will say, I do appreciate that, because also as I've made the comment about every time we've seen these rates, we see that tan or gray bar that shows a recession. It's usually after we reach a high point of interest rates for a period of time, enough to slow the economy. So we're actually not too far out of line. We'll talk about calling of a recession or not in 2024, 2025 in a few slides, but it's definitely an interesting spot where we are. And it's also not only just people based off of prime rates and floating rate loans. Borrowing longer term has become incredibly expensive. And here's a picture of the 10-year Treasury. And we haven't seen these levels in yield in the 10-year Treasury since going back to 2007, 2006, roughly there, and a very, very quick turn up in rates. I mean, if we look, obviously a lot of work was done by the Fed with the quantitative easing that happened back in 2020, 2021. We can see that that low point there. I'll hit it with the laser pointer. That low point, that was all the Fed's buying. So we shouldn't have gone down that extra bit, but we did. And so here's where we are today. But this is going to be very, very painful for a lot of people as loans reset.
I like how you said that. This is going to be directly tied to the cost of new issue debt, right? And whether you're a corporation, whether you're the government, whether you're an individual. So it's going to be hitting all aspects, or pillars, if you will, of the economy that helps drive economic growth. And it's going to get very expensive.
That's the Fed's goal. They're raising rates to slow the economy, and if it's going to hit consumers, governments, employees, everyone, that's their goal. Unfortunately, we tend to forget about that. It's not that they want to be mean, but they've got to slow the activity to get rid of the inflation. Where I don't see a lot of inflationary area is in mortgages. Not too many of those getting written anymore.
No, I'd like to reference somebody was saying the mortgage market is pretty much dead right now.
Yeah, dead's a good term. That's tough. We'll see, but obviously it's hard for someone to walk away from a 3% or 2.75% 30-year fixed rate mortgage, especially if you have to go borrow it, not only borrow at a higher interest rate, which doubles your payment, but a more expensive home. So it really becomes difficult for affordability to move. And speaking of housing affordability here, this is a chart that I just was shocked and confused. And I get it now, but I'm still confused. But we have here is a 30-year mortgage rate in blue from 1987, going from 11% all the way down to 2021, 2022 at 3%, and 275 in there for a little bit, but 3%. And then we've skyrocketed right back up basically to 8% right now. The same point, the red line is the value of homes. Now that hump in the middle there, which is kind of fun, that's what we call the overpricing, the home devaluation, the home crisis, the financial crisis, whatever we want to call it. We then recovered here and then skyrocketed since then. Affordability is definitely a tough spot today, Greg.
It really is, and it is a conundrum here, I think, is what we use the term to coin the term. And I like to really look at like 21 and to the right. So just the right side of this. And this is, what is driving this high rates and high valuations? It goes down to two things. One being the supply demand issue, just not enough homes being built for people. But the other one is, and I won't use the term birth of an industry because the industry's been here forever, but I would say the explosion and adaptation of the rental markets, the VBROs, the other fintech sites where you can go and have rentals, and people just buying homes as investments for this. It's really have brought in a lot more buyers into the market than there historically has been.
Yeah, there's an article in the Wall Street Journal this week about a large hedge fund or large fund buying up homes now in Florida, even at these prices, because they think it's still cheaper than going to a hotel. And if that continues, that's going to continue to drive up housing prices. But with that, you made a great comment. Not a lot of new homes being built. That's the red line. We're going back from on the left-hand side of the chart from 2008 to today. And we were down, listen, right before the world fell apart with the great crisis, financial crisis. We almost got up to 1.5 million, 2 million homes a year. I think the biggest growth, but that was just for a few quarters in annualization. It took us 10 years plus to recover. And we finally recovered, but we've built way too few homes for the past 10 years. And so we are definitely struggling with that. And now the cost of building a home is so high. Um, so what ends up happening here is used home sales, the blue line, we're now down to 4 million. That's where we were after the financial crisis. And I expect that number to continue to come down, which is really going to be difficult if we think about, moving, because without more homes out there, without people selling homes, it's going to hold prices higher much longer because of scarcity value.
Right. Right. I think just the rough math in the back of my mind, we need to have the new home builds to increase by about 30% to get back to what we really need from a supply demand issue. Get up to that 800,000 range, if you will.
Yeah. It's interesting to me. It's going to be tough to get there, and it's expensive for people to build right now. And that's going to be one of the challenges. And this also rolls down the hill a little bit, as I like to say. When you build a house, you have to buy a washer, a dryer, dishwasher, refrigerator. And when you remodel a house, you do that. But where interest rates are today, it's going to be tough for people to be remodeling at great sizes and tough for people to be buying a great new big home. So it's going to be an interesting time. What's going on in the automotive market?
So I love looking at this chart. And if you kind of look historically, because we love to have some history and some trends going on, uh, eyeballing again somewhere around that annualized 15 million units is historically, and you got that beautiful laser beam that you borrowed from Austin Power there. That's lovely. We're right in that sweet zone right now. And one of the things that we had the whole supply chain issue that's we've pretty much recovered from, and we're starting to build more. And one of the things we think about in autos is there enough for what people want? And are they affordable is the next thing. Interest rates right now, it's very expensive to be financing your autos. And we went through this whole industry change of where a 3 to 5 year auto loan was kind of the norm for decades. And now norm is 5 to 8 years. And when we think about that and a declining value, we got to be really careful in that lending world. But ultimately, you look at the auto sales, and we'll talk a little bit about the UAW strike. I think we're in a good spot right now for bringing the supply to the market. The issue is the cost of new cars, and is it affordable for most people?
Yeah, we've had an interesting issue where costs have been rising. We also have some pretty big chunks of lack of building from the financial crisis when a lot of automotive manufacturers and suppliers went bankrupt. You can see that big V there, this missing number of cars. And now we hit COVID here, which caused some more. So it's really a supply and demand problem. And now with the automotive costs going up, the new car costs are so much higher, but used car costs have really gone up, Craig. It's quite surprising.
Yeah, that's the if we continue to build without any kind of industry interruption, will the supply outpace for a long period of time to bring down that in equilibrium and bring down used cars prices is the question. It seems like even if you look at a historical trend based on inflation since 2019, 20, we're on a normal pace. And if you follow that line, we've got a long ways to go if we want to kind of go back to a normalized inflationary asset value.
Yeah, it's going to take a while, and it'll be interesting to see. But it's hard to find a used car right now, and that makes it the supply and demand issue. The same thing with housing, just not enough supply. And from here, it's interesting, and I know why there's not enough supply in some things. So ISM manufacturing is a value of business activity and business orders, and below 50 is recessionary or slowing, and above 50 is growth. And we're just below 50 right now. We're at 49.2. It's come up quite a bit in the past couple quarters, but we've been below 50 for about a year or so now, a year and a half now, and that shows it's a contraction, which does make sense when you see the automotive numbers and some of the housing numbers.
Yeah. This is one of the big, meaningful numbers that we want to continue to look at as we kind of gauge what's happening in the economy if, for expansionary or contracting in the economy. And right now, as you said, since early to mid 2022, we've been contracting in the manufacturing
Yeah.
space.
And it's not only us. If we look at the rest of the world, it's the same thing. So it is a global slowing. Here is the sum of the US, Chinese, and Eurozone ISM. We bring all those together. The 350 plus 50 plus 50 is 150. So below 150 is a slowing, above 150 is growth. And we had some amazing growth going on, post COVID or post hit of a pandemic, and then we've come down quite a bit from there. So definitely a bit of a slowing time right now across the world in activity. Well, from here, see credit default swaps. What are these?
Ooh, credit default swaps, traditionally always used to really understand what is happening to credit out in the marketplace. It's a measurement of the probability of a issuer or a asset class. This is on commercial investment grade credits, and you'll see this trend. You look back historically, it has some volatility right around your recessionary times. Really big peak you can see when we had the pandemic in early 2020 came down to settle to normal times, normal levels. But now, since we're starting to get into these higher rate environment, you can see that slow trend of this number going up. And what that is the market expecting that there are going to be some credit events on investment grade borrowers that are going to cause pain, if you will, to investors or lenders out there.
There's a lot of people right now with 10% plus yielding floating rate debt, and that becomes very expensive to pay when you're used to 3 and 4%. And so it makes it a tough environment.
Mhm.
But one thing we're not seeing is delinquency rise substantially. Delinquency is obviously down quite a bit from where we were. It peaked like crazy with the onset of that was the recession, the Great Recession. There, I keep thinking that's pandemic, but we're looking at time frame here, and we did come up a little bit there off to the right when we see that we hit the pandemic, but we're still really low. We're around 1% right now with all debt at the moment.
Yeah. And this is on commercial real estate loans. One of our expectations as we had a lot of commercial loans resetting this year, but as we go into 2024, there's a big hundreds of millions, billions of dollars resetting on commercial real estate. That's where we're going to expect some additional defaults, and we're going to see this trend up a little bit more.
Yep, and it's if you think 5/1 ARM is 20% a year, and we're only a year into this, so we're going to see a lot of things start to reset. And we are seeing things go back up to normal here. We're almost one of the things is we dropped down super low in 2022 with all the pandemic funds and what had happened. But now we're seeing come back to normal levels. We have the rolling 4 quarters charge-offs in yellow here that's coming up. And then we're seeing recoveries go nowhere, which shouldn't surprise anyone. Net of charge-offs, the black line is still coming up right in the same path. And then delinquency in blue is coming up too. So we're seeing all of the trends show things moving up. Is this a whole new trend, or is this just getting back to normal? That's one thing we'll probably learn quite a bit in the next couple of months.
Yeah. When one of the things that the Fed is trying to orchestrate is to get back to a normal without blowing through that normal trend line, or at least not go through it too much. We don't want to overcook or over tighten.
They're trying to land the plane they took the gas out of without shooting holes in the wings is basically what you're saying.
Yeah, something of
Okay,
that
got that.
nature.
Well, I think one of the things we're learning here is, and I appreciate you pointing out that that's commercial, the 2 slides ago. What we have here is different types of places of commercial property is doing better than others. Office is the really struggling, while warehouses are doing really well. In some areas, big box stores are doing well. But not only type, but physical location here and where we are in Michigan. We're between basically Troy and Birmingham, Michigan, where we sit today. Birmingham, Michigan has less than 5% vacancy, record low vacancy, and Troy has close to record high vacancy, 30 to 40%, depending on who you ask. It's interesting. Not everything is going to be applied equally here. Location matters, quality of property matters, so many different things. So it's so hard to draw a line here.
Oh, it sure is. And I think most everybody that's in our audience today kind of understands the C's of credit, if you will, but This is a little bit unique when you're going into the conveniences of lending, of who you're lending to, and what are the conveniences of that location and the collateral that you're looking at finance. A lot of people, when you do have, say, a slowing economy and there's not as many people out there looking for that space, they're going to spend a little bit more to go towards those conveniences. And that's kind of a great example of what's happened here between Birmingham and Troy. Both wonderful locations, but one just has a little bit more conveniences for the other.
More Starbucks close by. There you go.
Yeah,
It's
trendy,
all,
popular, convenient.
yeah,
Absolutely.
love it. Well, getting into deposits, lending was a great talk and where we're coming and what we expect to see. But deposits are something that's a big topic in our industry, obviously. And just to think back, guys, real quick, in this, we've shown you the slide, the M2, we have this massive growth in deposits, money supply, money coming in, and now it's reverting back out. And I think a better chart to kick off here is our next chart, which is a picture of change of deposits in the banking system. This is by the FDIC. Craig, there's definitely a couple skyscrapers in 2020, 2021, and then we see some tunnel digging in 2022, 2023 here. Pretty crazy swings.
Yeah, everybody has experienced the surge deposits, and I love when we're going through those stages of the regulators asking us to make sure that we model surge deposits, and
Yeah.
will there be surge withdrawals, right? And I think now, if we look back for 2023, part of 2022, I would call that some surge withdrawals taking place right there, right? Some normalization of where the money is, and the question is what's happening to all the money? Where is it going? What is that whole inflation? It costs a lot more to buy something today. The analogy of buying a loaf of bread, right? It's twice as much as it was 2 years ago. So maybe buying the same volume of things for some households, but it's costing twice as much. The other thing, they're just outright spending money. Then the other thing is there's the money still is in the system. It just depends on where it's at. It's almost like the Where's Waldo,
That was a good one. You threw me for that one.
right?
It is a lot of money. And if you look at the dollar amounts that came in here, there could be $2 to $3 trillion that just is still here, even though a number of it's gone out. And some people have still money around, is what you're probably saying here.
Mhm.
And I think this next chart might help answer that question. Besides probably the ugly sweater contest winner of the day, what does this chart tell us?
Because Waldo's usually what? Is it just red and white for Waldo? Huh?
Usually, I
I
think,
can't.
yeah.
So this actually is the amount of money that is still in our system, but parked at money market mutual funds. And you get to that number of $6 trillion approximately. It's just shy. That's still out there. It's just transferred off of our customers, our clients' balance sheets, the savings accounts, the money market, so the checking accounts, and into money market mutual funds. Huge trend. The balances invested in money market mutual funds is at historical highs. Never been this high ever. So there's some of that money is still around. It's just a matter of when will it come back? And that's a good conversation actually of curve, interest rate curve, and how it can make it shift.
Sorry to play with a little red dot there. I was struggling to get it to the right spot. So a little
Ah, so
excitement on the bottom there.
yeah,
Uh,
you can see in that
yeah.
2020 where we had the a lot of the COVID cash come in there, that surge in money market. Now, all of our balance sheets had that surge as well, in addition to these money markets. But now you can see where we've lagged, and money market funds rates haven't lagged. They've benefited from not lagging those interest rates, and that's where we had that additional outflow from our balance sheets to the money market mutual funds.
And it is interesting here. We're going from 3 trillion to 6 trillion. So quite a big pickup. And that's effectively the money that's still left in the system. I think it's a lot of ways it's gone. It's really interesting today. There's people going from one money market account to another because rates are so different in money market accounts today.
Yeah. So you
So
combine this along with that spending, the inflation, that kind of makes sense if that liquidity is becoming an issue for a lot of people.
yeah, but this is something that's going to continue to be a problem as we go forward.
Yeah.
Well, going over to the second leg of the stool is a second leg here with the Fed's activities, full employment and price stability, and looking at full employment. A lot of things going on. And I love this chart. I've shown it to you guys a number of times over the years. Effectively, what this is telling us is this is the working ages from, Taco Bell working ages to normal jobs to then retirement over here. there's a chunk of people missing. Gen X was a smaller generation, and early millennials was a smaller generation than the baby boomers. Now, the baby boomers are shrinking here, guys. There's a couple that are falling off the cliff, I should say. But definitely, we have a lack of people right now, and we haven't had good immigration policy to bring and fill people in. But we've got a lack of people, and so that's making it tough. And then also, people decided to retire because of what's happening in this world. And so with people retiring, it's causing some challenges to fill, and that's hurting our unemployment rate quite a bit, or making it really low.
Yeah, as people roll off and retire, and there was a lot of people rolling off in that silent and baby boomers, it's really impacting our unemployment rate. And then the Gen Xers with that work-life balance, right? It's either they didn't exist, right? Average number of child per family, as well as work-life balance as well. I'm not going to be working as much or working at all, quite frankly. It's really putting a damper on why our unemployment rate is actually so good,
Yeah,
so low. I want to say it's negative, but it's
no,
it's a
it's a
positive number.
positive. A lot of you're seeing a lot of Gen Xers where they're having one of the working or one of the parents stay at home with kids. So that's also hurting quite a bit. But here we are as a result of that is the unemployment rate. We haven't seen this unemployment rate this low, except if we take a quick stop here right pre-pandemic. And so some of this was pre-pandemic stuff. This is the trend with that demographic chart. But you've got to go back to 2000 until we hit these levels, and really quite tremendously low level of unemployment, which is really, really helping the economy. And this is the one chart in here that says we shouldn't be in a recession. This, if anything, says we still should see rates rising because it's almost too good. It's almost the opposite of all the other charts.
Yeah, that's a good point. And remember, this is leg two. Uh,
Yep,
Leg two.
leg two.
Fed's mandate, price stability. We're trending in that direction with the inflation rate coming down. And now you look at the unemployment rate, it has ticked up a little bit, but that's okay. It's still historically low.
Yeah,
You look under 5%, still great for a country, right? A lot of people
yeah.
love 4. I say under 5 is full employment, and we're a long ways away. It can tick up even more with what's happening. So it's just a really good number of what the
Yeah.
Fed's trying to accomplish right now.
They're achieving this objective very well.
Yes.
Now, we are seeing, and if we think about this pre-COVID, number of job openings were about 2.6 million less than today. And so what we're showing here is when COVID hit, a lot of people, a lot of jobs went away, but jobs came back quickly and people exited the workforce. We had people leave in many different ways. And the number of open jobs has come down quite a bit. So we're heading in the right direction. And we're seeing the number of people shifting jobs and people moving jobs. It's slowing down quite a bit right now.
Yeah, it's trending down, and I think there's a lot of companies that have went through that whole. You mentioned there's a lot of reasons, right? That it exploded, and now it's coming down. There's a lot of companies that are continuously right sizing their workforce as well. Plus with automation coming on.
Yep, a lot of changes took place there. Well, going to the next slide with job openings, we have job strikes. I guess we should call this the year of strikes here in Michigan. We had a lot: UAW, Unifor, Canadian Auto Workers in California, Kaiser Permanente. Also, the actors, they've all actually got tentative agreements now being voted on. A lot of labor pushing things. Mack Truck, Detroit Casino, Blue Cross Blue Shield, Las Vegas Culinary are all still on strike. So a lot of things happening, and I know the UAW strikes were interesting. They're not just Michigan anymore. There's plants all over the country. So that definitely is causing a lot of change, and people were struggling. We did see a number of institutions offering special lending to auto workers because of the strikes. But in the end, I think the result of all this here is that cost of manufacturing is skyrocketing in this country, and we've seen a number of places go to levels that probably won't be sustainable. And this is one of the worries for someone living in Michigan. Did they go too far, which is going to cause the boom and bust cycle to repeat? And so here, GM says its offer would boost average UAW worker pay to 150,000. Just some really, really huge numbers. Don't know how much this was positioning of the company. Don't know how much it's true. It's the beginning of a 4-year deal that they struck of a 20 to 23, 24% price increase or pay increase over that time. But definitely some big costs of employment that are going to start to cause, we think, some potential negative effect in the industry.
Oh, sure. One of them, just because it's auto industry, is going to be new car prices are going to continue to rise, we would imagine. And that could have actually an ancillary effect on the cost of used cars. That could actually support used car prices because new cars are getting a little bit unaffordable for most people.
Yeah.
Yeah.
You're seeing a couple $1,000s per car with all this passing, so that's going to cause a lot. It's going to make a lot of automation come into play. But well, with that, we want to get into some federal economic issues and a wrap up for our presentation. And I think one of the things to just kick off is the S&P 500. Um, there's two ways of looking at this. One way to look at it is that we haven't seen the value move very much in the past couple of years here now, Craig, or past 2 years. But you have some different view on this chart.
I really do. I like to look at the trends of things. I've used that word many times during a presentation and past presentations. But if we kind of just pause for a moment and kind of look what happened during the pandemic, had a huge drop, right? And we had the COVID cash coming in. People were saving, they were buying homes, they were buying cars, they were investing in the stock market. Massive historical number of brokerage accounts being opened, surging in that world. Day traders are born everywhere, right? If you had a dollar, you could day trade. We hit that peak in beginning of 2022, and then we're starting to see some volatility coming down there. And then we kind of went through that trough again of in 2022. But my point here is if you do a trend from say 2019 pre-pandemic to where we're at now, take all that volatility, the massive swings and devaluation that the sky is falling, their wealth that has been built is just tremendous. And I thank you. You're drawing a great line. You're very good with crayons. So well done,
Thank you.
Charlie.
I work at them. Watercolors. I'm even better.
I understand. Yep, absolutely. Oh, you're on watercolor on canvas now. I
Yep,
love it.
moving up in the world.
But yeah, so that you can see, even with the volatility, even with the 22 devaluation this year, there's a long devaluation of sell-off in stocks. There's still a tremendous amount of wealth in the stock market, which is helping offset some of this drain of the money supply, some of the inflationary effects of all the cost as well. And it kind of starts to create a theme of where we feel the economy is going to go and how it's going to perform end of this year and into 2024.
Yep. There's a lot of growth and value in the stock market, and there's also a lot of growth and value in homes.
Yeah.
But on a negative side, there's a lot more debt outstanding at the federal government level. And
Oh, now
man,
you're going to put me in a bad mood now talking about the federal debt.
yeah, it's gotten out of control. I think it's the short term here we can say, and it just continues to go up. I know you're going to bring up something about a deficit reduction committee, which I'll say reminds me of the inflation reduction committee, which means they're just going to spend more money.
Yeah, yeah. So the argument, the conversation we had this morning was, the Fiscal Responsibility Act, which is now they need to create the Fiscal Responsibility Commission, and we that commission, they're going to get paid a lot of money to be a part of this commission. It's not going to be a voluntary thing, but yeah, you look at the amount of debt that's retiring, and you could stay on this page, but they're expecting about half of the U.S. debt to be maturing over the next 3 years. So let's just say the average cost of that debt is 2% to the government. And now they're refinancing over the next couple of years, starting now with a 5 handle on that interest rate.
Yeah.
Now, they really do need to have some come down, because look at this line that you have up here. It's just amazing how the growth of the cost is taking place. And what's the colors versus the black line here?
It's interesting. Yellow is debt payment, the interest payment, just to that. The red is the mandatory spending, and that's the stuff that they actually have to have an act to cut, so Social Security and things like that. The green is discretionary spending, and the black line, unfortunately or fortunately, is revenue. Right now, we're not covering; we're just covering mandatory spending, and this is the CBO baseline forecast, which I bet has been too low for the past 50 years, also.
That's interesting. So what I'm seeing here is 2 to 3 trillion deficit is what I'm kind of seeing with no end in sight. Is that correct?
That is correct, and it's growing more and more every day. So I don't know, the elected fools, depending on or all sides, I can call them. No one understands fiscal responsibility. Now, with that, I think that that gives us some viewpoint of where we're going here, and that is going to be one of the biggest headwinds. We wanted to bring it up. I know we've shared this chart with you a whole bunch of times. The red dotted line is the Fed funds rate, the blue line is the 2-year Treasury, and the black line is the 10-year Treasury. And again, as we looked at earlier, some of the comments we made, we're at that point now that looks very similar to where we were in 2006. We seem to be right about here. Same thing a little bit as we saw rates going up here. This kind of normalization of rates is what we called it back then. So we're really looking, and as we think about projecting forward here, Craig, we seem to be at a spot where we're at a little bit of a pause with interest rates. Is that a fair statement?
I think it's a fair statement and should be really supplemented with what you just pointed out is what happens after we get those peaks, where we get the inversions, the Fed funds being over the 10-year. Over the last couple weeks, we've been actually toying with a positive slope yield curve between fives and tens, for example. So it's starting to get to that, or as we expected, getting towards a flatter yield curve. And as we go through there, after you see this peak and an inversion, is you either expect one of two things or both. Is one is a recession,
Mhm.
right? And then two is for rates to come down. And we're going to see that with markets are expecting some Fed funds to come down. And we don't know what's going to happen to the shape of the yield curve because we are truly in a unique situation with respect to how we got to this point. The COVID cash, the money supply that just went off the charts of growth. So it's going to be a little more unique this time, but this it's going to be pretty representative. This chart shows pretty representative of kind of the trend of where we're going to go to.
And speaking of trend, we've got some projections here,
Ooh.
and which I love. And you just made a comment that we're looking at rates potentially coming down a little bit, and starting with the Fed funds rate, looks like you've got them coming down in June of 24 by 25 basis points.
Yeah, we're kind of looking at the trend. One of the data points, the very bottom is inflation, right? And what we don't have is the PCE on here, which is a point or two lower than that. And we're expecting that as we see inflation continue to trend down, we looked at those lines, that we'll get to the PCE in 2024 with a two handle. Right. And then the CPI trailing a little bit and the overall total headline risk with food and energy, that's going to be volatile through time. That's why we like to focus on a core. And now the key, though, the question came up is saying, well, let's look at that June of 24. By June 30th, there's a few Fed meetings prior to that. Core CPI is still above 2, but trending down. Why would we expect rates to come down on the overnight lending rate, Fed funds? And the answer is trying to time perfectly, which it's never perfect, but maybe making sure we don't stay too high for too long, right? If the trend's happening and we continue to lower, that trend's going to continue. There's trailing effects that's going to happen. So we do expect them to start coming down with the CPI continuing and trailing there. And we're starting to see, if you look at the changes in the twos, the fives and tens, the shape of the yield curve starting to change as well.
In reality, what you're saying a different way is that the Fed should probably bring rates down a little faster than they have in the past, because to get a soft landing, you've got to be a little bit more forward looking.
Yeah, that historical Fed funds rate, is don't stair step down. We don't expect it to go down to zero again. Don't get all excited in the audience that your cost of funds is going to go down to 0.011, or point 0. But yeah, we do expect them to come down and adjust and then kind of settle in somewhere in that 3 to 4% range.
Wonderful. I appreciate that. As usual, please reach out to your advisor, your MFA advisor, and they can get you a copy of the slides and check it out. There'll also be a copy of the webinar on our website. So please feel free to reach out and love to share it with you. All right. From there, a couple things to wrap up with for the remainder of the presentation. What are some of their thoughts besides our interest rate projections, which is, second quarter, third quarter of next year, rates start to come down a little bit. We do still see, though, higher interest rates for longer. We're not predicting rates going down, as Craig just said, to 1%. They're going to come down, but probably slowly and not nearly as quick as what people want. You agree with that statement?
Yep, very well said.
Inflation's slowing. It has been slowing. It's going to continue. The consumer, we're going to see them continue to spend less. I expect that business activity is going to slow and job growth is going to slow here. So I think it definitely, we're seeing a slowing of economy. Like you said later, recession's all crawled in hindsight. Are we in a recession? Are we close to a recession? I'll tell you in a year. The best way to do it. But things are definitely starting to slow down, and I do think the expense of labor and labor leverage is something that's going to start to cause additional slowdown in business activity today. From there, we got a couple wars. Definitely not a good thing unless you're building, machine guns and bombs, I guess. But most of us, it's a really bad thing, and expect that to continue that way. And then political polarization is something that's really, a troublesome thing as we are entering into a election cycle here in a presidential election, and that with all this debt, it's just a lot of polarization versus the 90% that are or 80% that are in the middle talking. We listen to the 10% on each end, the crazy ends. I just wish we had less political polarization and more communication as a country.
Yeah, we need a third and fourth majority party coming out to balance everything out, and I think that may start to happen, but that's
Yeah.
decades away from now.
It'd be logical, but also scary because then maybe the government would do something, and that's a bad outcome, I think. But well, on a personal standpoint here, housing values, man, we argued over this number for way too long today and the last 2 weeks. It's going to be tough. Homes are definitely unaffordable to go and buy, um, but supply and demand dictates that the value is going to stay higher longer than I want to see or believe should happen.
Yeah, and clearly interest rates haven't have had a major impact. They have impacted affordability, and has really in certain um, dollar class properties actually impacted values quite a bit. But for the national average of house price, the higher interest rate hasn't necessarily impacted that as much as we thought it would. They've really been really resilient.
Yep, it's been resilient. I do worry that a lot of young kids today just don't see home buying as attainable. And so we see kids spending money in other ways, which is helping, boost the economy with travel and car purchases and things like that. We do think, though, that we're going to continue to see some job openings decline. The stock market's going to struggle. The 10-year Treasury uses a discount rate. So the 10-year Treasury stays high. It's going to be tough on valuations. It comes down. It's going to help. Mortgage rates, until we see a big change of interest rates, they're going to stay high. And then home equity rates and borrowing rates, mortgage rates, prime rates of borrowing and home equity are going to be high, which is going to definitely put a strain on that part of the economy. Car prices you expect to stay high.
Yeah, as we saw, with UAW, those costs are going to have pressure on actual cost to manufacture cars. We expect that to have a direct impact on the cost of a car rolling off the line, which is the effect on the used cars is going to be just the same. So people will start to continue to support the used car market, and cars are lasting longer. It's not a bad thing to have a used car because they last so long and they're well built.
Yep. And it's always interesting here in Detroit. We get to hear all those numbers about the average loss on an electric vehicle sold, and it's a big 5-digit number. So they're losing a lot of money in electric cars and making a lot of money in gas cars. So it'll be interesting to see where that goes. One of the things I do think is a positive here, the Wall Street Journal ran an article the other day highlighting 4 families and how 3 of the 4 families were doing really quite well because pay was up, but their fixed rate mortgage wasn't moving. Their car loans weren't changing. They still were driving the same car, and they were able to spend freely, go on trips and do things. So it is interesting. Pay does help a lot of this happen. And if you're not going and buying a house today, it's not a bad spot. And so we're seeing people do really, really quite well in that situation.
Yeah, for those that are locked into their debt payments and don't have that escalating. It was an interesting article actually.
Yeah. Well, a couple pointed things for financial institutions to think about here. Really, really difficult discussion here. Everything we see with deposits, and Craig, your Where's Waldo graph was absolutely wonderful when looking at how much money is going into money market accounts. I think it's one of the most telling graphs we have here today. But also looking at the quantitative tightening that's taking place. All these different things are taking place, which is causing deposits to be a struggle and people spending more money every day, and food prices being high, still coming down a little bit, but um, we're predicting here deposits flat to minus 9.99% is what I was going to change this to, but left it at 10. It's going to be tough.
It will be tough, and and just thinking about thoughts for 2024 is just planning for that, making sure you have all the pieces in place in order to accomplish deposit stability for your institution.
But from there, we do think loans are not going to be as difficult, but there's still going to be a struggle. It's hard to borrow money today at these new rates and be able to afford it. We want to grow loans. We want to make sure we're putting loans in the books every day to help boost our yield on assets. It's actually a great day to talk with our investment advisors about rearranging your investment portfolio. What can we do to swap to boost our yield up to really lock in good long-term earning assets at this point? So we do think it's a great day to grow loans, to swap investments and change to higher yields, because we are going to see some more difficult things. We look at just the trend where loan loss reserves are going. CECL reserves is going to have to go up. Cost of funds are going to have to go up even more to retain those money market accounts. So that's going to be margin pressure is going to continue to go up. And so I look at 2024 to me as a great year to focus on process and profit versus growth. I believe in grow or die. You want to grow over a 3, 4, 5 year time frame, but you don't have to grow every single year. And this may be one of those years to really focus on process over growth.
I think that's well said. And the one that really hit home for me in these bullet points is not what it's written in the bullet point, but what your words chosen to use was, we still need to lend. We really need to continue to add on earning assets in this higher rate environment. It's a crapshoot on whether we're going to be higher or lower, but we do have overall sense that rates should be lower in 12 to 24 months from now. It's great to lock in as many high earning assets as we can today. And also, if you're using your investment portfolio, use it with not a lot of negative convexity. The lending we can't control as much. I don't know if it will have the appetite, or borrowers will have the appetite for prepay penalties or anything of that nature, but you really got to start rethinking about those floors and prepayment penalties as well.
Yep. Well, with that, I really want to thank everyone for joining us today. I know there are a lot of things going on in this world, a lot of uncertainties with wars and Fed and rate changes and forecasting. I think the best news here is that we are all in a great country that's doing well, and we're all working really well towards good things. And fortunately, we've got a lot of fixed rate mortgages, so it's making people's lives a lot easier. So with that, Craig, thank you very much for joining me today.
You're welcome. Thank you for me for being able to participate and enjoyed the conversation.
Yeah, great conversation, great insight. You've been spot on with your economic presentations, and I expect that to continue. So thank you for the time. Thank you all again. Please reach out to your MFA advisor. We'll have copies of this available for you. Also, our copy of this will be on our website, and we look forward to seeing you all soon. Have a wonderful day.